Good afternoon and welcome to our webinar. My name is Jonathan Albano. I'm a partner here at CCR Wealth Management. I'm joined by John Maher, our Chief Investment Officer. We're reporting to you today from a rainy Thursday afternoon in Westboro, Mass. And we are very excited that you could join us today. I am a partner with CCR Wealth Management. I head up the Financial Planning Department. John, again, is our Chief Investment Officer. Just a little bit of housekeeping. Please remember that if you do have a question, just click on the orange arrow and a box will pop up where you can type a question, click submit or enter, and we'll take your questions. Obviously, we're looking for this to be as interactive as possible. So we're coming to you from a little bit of a different location in the office, but again, we're happy for everybody to join us today. So, John.
Thank you, John. Thank you. Hello, everybody, and welcome. Yeah, as we changed rooms from our last webinar, I understand there were some sound issues there. Hopefully, those are a little bit mitigated. Maybe something else is going to be an issue. But as we work through our technology bugs, you know, hopefully we get better and better as time goes on. Quick reminder that as I had mentioned in February, this is not mad money, right? So individual stock recommendations, buy, hold, sell, is not going to happen today, and we're not going to talk necessarily about specific investments, specific mutual funds. I'm happy to talk to you about those issues. You want to catch me offline, or you can obviously talk to your advisor to follow up. So anyway, you know, I apologize for the delay. As you know, this webcast was supposed to happen about a month ago. So this is really our June webcast happening in July. There's a death in my family, some other circumstances that forced that delay. But I was giving some thought to that, and this fact alone has caused me to think about what I think are some relevant issues, some things I'd like to talk about briefly that investors struggle with in this market. As you may know, I write our quarterly outlook, and I do it with editorial input from the rest of our team here. And in writing that piece, you know, it's something that usually looks both backward at the immediate past and forward at the foreseeable future. And you know, I struggle sometimes with the rapid pace of the news cycle. I call it more and more news cycle these days. You know, should I be writing about the unemployment rate? Well, gosh, you know, there's going to be new employment numbers coming out next week. Maybe that's going to invalidate whatever I say. Should I comment about interest rates? Gee, you know, the Fed meeting minutes are coming out next, you know, at the end of the week. Maybe that's going to completely change the direction I should be taking it. Or at least impact it. Correct. I mean, the news cycle is vicious, and you almost kind of, you know, don't want to make a comment lest that comment be completely thrown off track. Sometimes, I mean, thinking about this and thinking about what, you know, between last month and now, you know, I realized that, oh man, I'm going to probably have to completely revise all the plan commentary I made. But you know, sometimes we have to relearn lessons repeatedly, and one of the recurring lessons to me is to always question the narrative. And you know, the narrative permeates society, and with the news cycle, you know, everybody tends to be talking about the same thing. So I thought I would bring that up and you know, start by defining what we talk about when we talk about the narrative. So here's a Webster's Dictionary basic definition. You know, and there's actually 3 definitions, but all 3 involve the telling of a story. All right, whether it's a fictional story, whether it's a fact-based story, and people tell stories all the time. The problem with narrative, as I see it, is basically twofold. You know, narratives, first of all, are used, and they're used in the media to compress often very complex topics, complex information into easy to understand kind of bite-sized summaries. And in doing so, the problem is they necessarily omit relevant data. They omit probability analysis. They oftentimes omit alternative outcome possibilities. The issue here is that without these caveats, narrative easily takes on the imprimatur of truth or fact. And narratives can become, in investors' minds, foregone conclusions. The second issue I have with narrative is that narratives tend to be infectious. I mean, folks, like, if there's a recurring theme going through the last decade or so outlooks that I've written, it's probably that I hold most of the journalistic community in somewhat low esteem for a variety of reasons. One of these reasons, in my opinion, is just sheer laziness. Now, I think of a children's soccer game with 20 kids spending an hour or so, chasing a ball and converging on a soccer ball all over a field. With little strategy, little spatial, awareness.
I think we can all visualize that.
Again, media. Go back to you can date myself, but you can go back decades to the O.J. Simpson trial, where journalists kind of just spent more time interviewing each other, tossing that narrative back and forth, rather than they spent more time doing that than they did in providing any actual news. I mean, listen, the truth is that CNBC. If they focused on the facts alone, you'd have an entire day of programming. They'd have to condense it to about an hour and a half, and we know that that's not going to happen. But one thing when it comes to narrative that I repeatedly stress to our analysts here at CCR Wealth Management is to be aware of analysis that reads like a story, and to be aware of the difference between likely facts and an actual narrative.
So given that background and your interpretation of narrative, what's an example of a current narrative that we could discuss?
Narratives in the market abound. And certainly, over the last couple of months, there's been this kind of permeation of get my chart up here, a permeation of narrative surrounding what is called, what has been called and deemed the trade war.
That's definitely a topic that I've discussed many times.
I have no doubt. The fact of the matter is that the narrative is that the United States is in a trade war. That a trade war is currently underway. It's a given. If you tune into CNBC, if you tune into CNN, every broadcast is an update on the trade war.
It's a minute by minute.
You've seen it scroll across the bottom of the screen,
including yesterday afternoon at 4 o'clock.
Well, yeah, and that's an update, and I think that tends to illustrate my point about narrative. In my view, though, the term trade war is used carelessly. Carelessly, because I think the facts get lost in this conversation, and is either underreported or worse than that, it's ignored entirely. So to date, and here is the fact. Pull this up. The tariff implementations that have been enacted by policy so far during this trade tensions, this trade spat, both by the U.S. and by our trading partners, associated retaliations, amounts to only 5% of the trade that the United States engages in. 5% of U.S. imports and exports. So talk of a resulting slowdown in U.S. GDP due to these enacted policies is premature, premature at best. Measures already implemented will not have any kind of a significant macroeconomic impact, certainly not on a global scale. So again, trade war is not how we would describe the current situation. Understand completely, yes, further tariff possibilities have been floated, but we maintain that what we are witnessing is a negotiation, and it's not a trade war. My concern is that the narrative that the narrative of trade war that everybody seems to be bandying about, nobody really understands what a trade war would look like. Certainly not in this day and age. The last trade war was 85 years ago, 89, depending on when you pick the start date.
So it's a complicated issue. Obviously, with the way that supply chains work globally. What's an example of a situation that you can reference to illustrate the different facets of that?
Yeah, globalization of trade over the last couple of decades has made this a thorny issue, and it's not just an us versus them issue. And again, I think this is why it gets overly simplified and talked about a trade war. For example, recently, and it was last month, Daimler, German company, issued a profit warning. And a profit warning is not an earnings, drop. A profit warning is simply an outlook that says, oh, we think we're going to make less money over the coming quarters. And they blamed it on trade tensions between the U.S. and China, right? You see, several German automakers, BMW, Daimler, Volkswagen, produce many, if not most of the SUVs they export to China right here in the United States. So there's an irony here, which also exists in most global supply chains around the world. German automakers get hurt. They get hurt the most by rising Chinese tariffs aimed at U.S. automakers. Kind of weird. I mean, think General Motors.
It's counterintuitive.
General Motors, meanwhile, produces most of their low-end SUVs sold in China at 2 different plants in China and would sidestep these tariffs altogether. So given today's global supply chains, and this is true of many industries, not just the auto industry, it is a much more complicated situation. And I don't think the term trade war captures, captures it accurately. And I also think it brushes under the table the negotiation aspect of the strategic negotiation aspect of this.
So you referenced China. That's an interesting topic because that's definitely come into some of the context of my discussions with people and clients. What are your thoughts about a trade war, or increased tension with China, and how could that affect the global markets?
Well, as I mentioned, I'm going to put this chart back up. I think it can be useful to make this point. As I mentioned, we do recognize that there is a danger in increased protectionism, and we're not kind of sweeping that under the rug as a possibility. We don't think that's happening now. We do believe this is a negotiation process. And frankly, at 4 o'clock last night, news came out between the European Union and the United States. It's short on fact, but it certainly sounds like a framework is being formed that kind of underscores our point that this is a negotiation process. But in terms of tariffs and trade tensions increasing around the rest of the world, if that possibility exists, I would point to this particular chart and show you that, well, let me go back first and say that there is another aspect to this narrative, and the narrative is that, well, in a trade war, nobody wins. I suppose that that's true. I mean, the winner, it's kind of the recipient of a Pyrrhic victory. But if you think of it in terms of negotiation, take a look at the United States. I mean, 8% of our gross domestic product is attributable to our export of goods. And that is significantly less than most of the rest of the world. Now, if you go back to, if you compare the United States, for example, to Taiwan or Korea or Mexico, you see that purple line, that's the amount of trade that's going to China. China, in fact, is exporting something like 3.5 times what they import from the United States. I don't think that there's really any question about who gets hurt the worst in a trade war. I'm going to use that term. Let's use the term trade war. Increased escalation of protectionism is most likely to have the most negative impact on emerging markets. Okay. Now, having said that, hopefully most of our clients understand that in terms of direct investment, we actually don't have a lot in emerging markets in our models. But the United States, from a negotiation standpoint, certainly is in a stronger position to withstand the increased tensions.
So that's obviously a complicated issue and a timely issue that's on everybody's top of the mind. When we bring this back to CCR Wealth Management and our process for sourcing research data and kind of being able to dig through these narratives, can you describe the sources that we utilize for that, the differences for that helped us kind of cut through some of this? I'll call it noise, if you will.
Sure. Well, obviously, we expect of ourselves to all stay well informed, to understand the narratives that exist, and to follow the news, and whether it's the Wall Street Journal or Bloomberg or even CNBC, is to keep abreast of what's going on out there. So, okay, I'm a financial analyst, right? I'm a chartered financial analyst. I would be known, or I would be what is known on the street as a buy-side analyst, all right? And that's just really another way of saying that I spend my time and my efforts analyzing the analysis of others. Of course, we always believe in having an understanding of the narratives, but when it comes to hard research, I don't believe we're getting that. You really you stand to get that out of the media. So we have essentially two sources of what I consider to be hard research. The first would be, frankly, Wall Street firms and the companies we utilize for our own asset management. Companies like Goldman Sachs, JP Morgan, PIMCO. These are very large, very global firms. And these are firms that spend hundreds of millions of dollars every year on macroeconomic research and on fundamental bottom-up research. And frankly, they also spend tons of money, lobbying and staying in touch with both the United States government to have a good understanding of policy and as well as non-U.S. governments.
So there's a few firms out there that can have this depth in terms of producing this level of research.
Exactly. So having the fact that they manage billions and in some cases trillions of dollars also says, hey, they've got skin in the game. They have certainly an incentive to get it right. And we have our favorites in that space in terms of who we read and who we really follow. We also visit on site many of these companies. We talk with these portfolio managers. In some cases, we talk with their representatives on a fairly regular basis.
It's nice being objective too, to be able to really.
It is, and I would also add that CCR Wealth Management has, the benefit of size, that we have pretty good access to these managers as well. I would note that narrative is often contagious, and when it comes to the asset managers, and I've been doing this for 26 years, so I've seen this frequently. Personally, I'm on guard for narrative, and quite often we'll see, many of these asset managers coming along with the same narrative, views that really coalesce, and they're telling the same story, so to speak, whether it's global interest rates or global equities. And I've found in my own experience that when everybody's kind of converging in the same narrative, quite often that's the scenario that is least likely to happen.
Herd mentality.
All right. So one other source of information that we use on a daily basis is actually research that we pay for.
Okay.
So CCR Wealth Management pays many thousands of dollars a year to an outside independent macroeconomic research firm. It's called Capital Economics. As wealth managers, getting the macro right is oftentimes much more important than getting the micro scenarios correct. And Capital Economics, as I said, they are a macroeconomic research firm. They do not manage money. And I think that gives kind of a different incentive.
They have different objectives.
They have different objectives, and not the least of which is to earn their fees. And so we have found that macroeconomic research from Capital Economics often, I won't say always, but often has been a little bit of ahead of the curve when it comes to shifting directions.
One of the other common themes over probably the last month and a half that my conversations have been with clients is that they hear a lot about the economy doing so well. Things are doing fantastic. Economies, seem strong. Unemployment's low. But as compared to 2017, the capital markets are a lot rockier this year. Why would that be the case if the economy is doing so well?
Good question. It has been a repeated, topic that we've discussed throughout this year. I know we talked about it in the February webcast, and I will absolutely talk about it again because it's going to continue to happen. I firmly believe it. It was in May, the outlook that we put out, we use the term cross currents. So yeah, great economic news. In fact, month by month, the news just seems to have been getting better and better. We've had fiscal stimulus that was enacted late last year, and we expect that in large part to send GDP for the year up into the 3% range. Consumer spending is on track to grow by 3.6% this year, which is fantastic. Consumer spending is 2/3 of GDP. That's hugely important. You can even get inside those numbers and look at the Michigan Consumer Sentiment Index. The balance sheets of the household balance sheets are in fantastic shape. Business investing is now expanding faster than it has in many years. Unemployment, 3.8%. Unemployment's just been going from strong to stronger. 3.8%. Hey, that was April 2000 unemployment rate. You remember the irrational exuberance days. 3.8%. To do better than that, you got to go back to the 1960s.
So in spite of that,
right? In spite of that, yeah, you've had an increase in volatility relative to the last few years. Okay. And I will repeat this term. As a matter of fact, this is a chart we put it up before, certainly in our outlooks, but we've put it up in I believe this might have even been up in our February outlook. It's updated. But in a word, we're talking about a return to normalization, right? And that was a theme in February, and it remains a theme. Staying as objective as we can. Volatility this year is in fact below the long-term average. You consider volatility in this particular chart. We're talking about a drop in the S&P 500, top to bottom, intra-year. The average top to bottom drop going back 38 years is 13.8%. We dropped 10% this year at one point back in February.
It just feels.
It feels different because if you take a look at the chart, we really haven't had a lot of those drops over the last few years. But this 13.8% drop, by the way, go back almost 40 years. I mean, that coincides with a market that's going up 76% of the time or thereabouts. The second point I would make, and I've also made before, is that really it has to do with interest rates. Interest rates, both monetary policy and the Fed's asset purchasing programs have acted as a wet blanket. So as rates have been rising for the last 2 years, as the Fed has actually begun their unwinding of the balance sheet, so to speak, it's the removal of this wet blanket that kind of uncovers a lot of the volatility that's naturally occurring. I'd add to that day in, day out, the media is gonna have a narrative. For every spike up and spike down, whatever, is gonna be a different narrative. But that is the true reason. We always come back to interest rates.
Let's field a few questions here that are coming through from clients. One that we got, John, is gold is quite low now. Is it a good time to get in? I know that you're not commenting on any specific securities, but just in general. Obviously gold can play an important component to properly diversify portfolios.
So I'm not a gold bug. I never have. We do use gold in certain portfolios in very moderate amounts. Gold is low here, but gold is really very difficult to put an intrinsic value on, right? We can tell you when a bond is low because it really comes down to math. We can tell you when a stock is cheap. Oftentimes, most of the time, that comes down to math too, and it comes down to history. Gold, and we do those with discounted cash flows. Gold has no cash flow, right? It's difficult to say just how cheap is gold.
It doesn't pay a dividend.
It doesn't pay a dividend. There is no intrinsic value. Gold is cheap right now relative to where it's been over the last several years. But it's really difficult for me to say that, gold is cheap, therefore it's a great buy. Why is gold in our portfolios? We do use gold not because we think gold is going up. I've made this point to our advisors repeatedly. We buy gold not because we think gold is going up. We buy gold because of the correlation characteristics it has. So it has a very little correlation with interest rates, therefore bonds, and has very little correlation with stocks.
It's another diversifying.
So it's a diversifying agent.
One of the another question that we received is, can you talk about the global economy slowdown regardless of the trade war? What's the CCR outlook, and what are the tactical adjustments, if any, that we are undertaking?
It's a good point. If you don't mind, I think I would like to get a particular chart up. Bear with me for a moment. If I could find it. Global slowdown, regardless of the trade war. I think we're going to start with the U.S. and kind of work our way out. I'm going to try not to make this a long-winded answer, but it's going to end up being a long-winded answer. Anyway, over the last couple of years, we fielded a lot of questions about things like, market valuations. We've also mentioned, and I'm going to repeat this again, that bull markets don't die of old age. They're almost always killed by the Federal Reserve.
Raising interest rates.
Right. But a lot of these questions have been raised out there over among our clients, but even been bandied about in the media for the last couple of years. The chart that I'm showing to you, I think, either side tells the same tale. Is that this expansion, and we'd be looking at the light blue on the right side. That would be the bottom line. Is historically long. I mean, we're at 108 months, or we're in the 109th month, to be honest with you. While that's not the longest on record, certainly that pales in comparison to most expansionary periods in bull markets, certainly here in the U.S. The rest of the world, the U.S. and the rest of the world went through kind of a remarkable period in 2017. And the term to use to describe it was synchronized growth. Right? It was a Goldilocks scenario where you had particularly the European Union and many other economies around the world coming out of a slow period and accelerating over the previous 18 months, as the United States was kind of taking it from an already, let's say, a decent economy to an excellent economy, and a decent bull market to what happened in 2017, certainly into the beginning of this year. What's going on right now, I believe, is going to come back to that quote about interest rates. Make no mistake, the data is excellent. The data right now and for the foreseeable future, and let's say the foreseeable future is, 6 months, is excellent and is worth investing in. But the fact of the matter is that the fiscal stimulus is a temporary thing. We mentioned that in our outlooks on more than one occasion, that a fiscal stimulus is a one-time injection into the economy, right? The current tax rates are the new regime. And there's going to be no more big bump. There's no more 8 or 9% bump up in S&P 500 earnings as a result of new stimulus. We don't expect that to happen. As a matter of fact, the stimulus begins to wear off. We see that happening actually later this year, and we do see as this stimulant kind of wears out of the economy, one thing that's going to be felt more is higher interest rates. The fact that
it'll be counter.
Exactly. I mean, higher interest rates will be felt. We expect 2 more interest rate hikes this year, possibly, well, most likely 2 more next year. And these rate hikes will be biting into the economy more and more. We're already seeing rising mortgage rates, not skyrocketing mortgage rates, but we have seen rising mortgage rates. From a consumer standpoint, where you definitely have seen it is in skyrocketing credit card rates. Credit card rates have been one of the most sensitive to this interest rate hike. So yeah, I mean, we do see a slowdown. The R word, the recession word, we really haven't talked about that much, but there are forecasts out there, and I think a lot of them are credible forecasts that look at 2020, late 2019 as possibly being the end of this extraordinarily long market cycle. What's on the other side of that? Who knows? But a lot of those same, I think there's reason to believe that rather than the sharp V-shaped corrections or bear markets or even recessions, this slowdown is going to be more very shallow, more walk-shaped, maybe a little bit longer than it's usually been in the past.
And obviously 2008 is still fresh in a lot of our minds around here.
Right. Behavioral finance, recency bias, and I think it's important to look at the facts that surround you right now. Now, the second part of that question was tactically, what are we doing about it? And we have been doing things over the course of the last year or so, I think, in preparation. What we're not doing, what we'll never do, is go to cash, right? That's not who we are. We're not market timers. And I would quote Peter Lynch once again, the great Peter Lynch, Fidelity Magellan manager from the 1980s, who said, well, to paraphrase, that investors have lost more money trying to prepare for recessions than they ever lost in recessions. Some of the things we have done include reducing the credit risk in our portfolios, right? So very specifically, we eliminated high yield back in November. If you recall, high yield, we had already tapered that position, but we swapped high yield into actual U.S. Treasuries.
So increasing the credit quality is a method of preparing.
Right. Increasing credit quality, and I will say that most of what we've done has been on the fixed income side. I think it's why our fixed income portfolios have done well relative to the broader market. Increasing credit quality, reducing duration, so reducing interest rate risk, and we've brought maturities and durations in real tight. Being certainly willing to forego possible higher returns in place of expected lower volatility. And the last thing I would add is what we're not doing. So I mentioned before, we don't have a particularly big position in emerging markets. We haven't for a few years. Emerging markets did fantastically last year. I don't believe we missed out on anything. But emerging markets, as well as small cap, which is having a great year this year. Small cap has done well relative to large caps so far this year, because the perception is that small caps have less trade exposure, right? So they're up in the double-digit range, whereas the S&P is up maybe 6.5%. We're not increasing small cap. If we believe that this is a mature market cycle, and we do, small caps are not the place necessarily to be. That's a better place to be at the beginning of an market cycle.
Had another question, and it has to do with commodities. And what is our outlook on commodities? Obviously referencing oil, non-precious metals.
Our outlook on commodities is mildly bullish over the longer term. Commodities is kind of a term that encompasses a lot. We've already talked about gold. Well, precious metals is a commodity. But the outlook for oil, I believe, is solid. and oil, and let me just say energy in general. I do believe that regardless of a possible economic slowdown in the months ahead, that the economy globally is on much better footing than it's ever been. Certainly in terms of balance sheets.
Are you referencing 2006, 2007?
I'll go back to 2008, 2007, 2008.
In what ways? I'm sorry. Balance sheet, banks are concerned.
Balance sheet, banks are in good shape. Consumers are in better shape. But you also have, you've got these geopolitical bottlenecks, all right? So they're a bit of a wild card, but certainly the sanctions on Russia is one of them. OPEC, obviously another one. OPEC reluctantly agreed to raise output somewhat in response to what they perceived as very low oil prices. And you've got the Iranian sanctions, which are about to be re-implemented. So all these things affect oil, but we think solidly, oil is on solid footing, certainly relative to where it was 2 years ago, 3 years ago, when there was this massive energy glut, massive oil glut in the market that sent prices tanking down briefly as low as $30.
Domestic production probably plays a role.
In
comparison,
I think domestic production in the United States really prevents oil from getting back up to $90 a barrel. And we don't see that happening. So there's a difference between we're bullish on oil and we think energy is a solid business again. Because the United States has spent the last 15 years putting these little spigots in the ground all over the Midwest and the Northeast and the Southwest, called these shale basins, fracking, that allows us to really very quickly react to the supply and demand fluctuations. But commodities is not just energy. And one thing that's happened recently that has affected broad commodity baskets, because it's affected very deeply certain areas of commodities, and that has been the trade rhetoric. All right, so most commodity baskets also include, let's remember, base metals, things like copper, aluminum, tin. Also includes agriculture, and one of the kind of the sharpest points of rhetoric between China and the United States was soybeans, and so we saw a major disruption to pricing in the month of April into May, with a lot of commodities that are commonly traded around the globe. Soybeans in particular, wheat, corn, that sort of thing. But that again is rhetoric. We still consider that part of negotiation, and we don't necessarily look at that as kind of the new normal. So we think commodities are a decent buy here.
Another question that we have, John, and again, we're not going to talk specifically about stock recommendations or anything like that, but it's regarding something that is probably symbolic of the market that we're in. It's referencing to Facebook, and it's referencing Facebook's disappointing earnings release that occurred last evening. And in the context of the market, particularly that sector, what's your commentary about a giant tech firm or company like that, and such a miss on what Wall Street was expecting for revenue, more importantly, revenue growth projections?
Right. We've decided that we're going to not talk about individual stocks, but I'll go so far as to say anybody who's spoken to me knows that I never owned Facebook, therefore I missed out. But I'm still not a big fan of the business model. But in general, I'll talk about technology in general. Big company like Facebook.
Large cap growth.
Large cap growth. I think, my view is to in a portfolio is to minimize social media that exists for the sake of social media. I don't understand the business model. I don't know. I mean, I do understand that people are fickle. So how long is Facebook really going to be dominant? I'm not making a call on that. But because I don't really understand that business, I tend to steer clear of it. My focus has been on what I believe are some of the more pervasive and probably going to show to be more persistent themes in technology. And I've talked both internally to our group. I think I've written some pieces last summer about the advent and the march of artificial intelligence. I mean, that I do firmly believe the world 10 years from now, we're not going to recognize. It's
Secular changes in that.
massive changes, encompassing all aspects of life. I mean, from healthcare to, artificial intelligence is, we can, and we'll do it here, but you can map the kind of the evolution of it, but from machine learning all the way up to neural networks. That artificial intelligence is being harnessed and will continue to be harnessed, will continue to be refined to make enormous changes in the industry, and enormous changes in everybody's life. And I think on balance, Stephen Hawking's warnings aside, I think on balance for the better. I mean, I think of what a major pharmaceutical company can do with artificial intelligence in terms of coming up with a new molecule, a new molecule that may have taken 10 or 12 or 15 years and many billions of dollars of R&D 20 years ago. Who knows? Maybe they can do it in a weekend, with the right amount of data, with the fast, with the right amount of fast computing. So artificial, it's a broad topic, but every aspect of artificial intelligence I focus on, and some of the big ones are companies involved in data. Now, Facebook is involved in data, and that's become obviously a lightning rod for them, and is a lightning rod for them over in Europe right now, certainly, and that's been the cause of a lot of their disappointing front page news. But there are other types of data. You look at some massive companies out there and what they're doing with the cloud. That is the fastest growing segment, I believe, of this country and of the technology universe, and that's where I'm invested in.
Well, I see by the time we're kind of coming to the end, so we're probably gonna end this webinar. Yeah, it goes by fast. I want to thank everybody for attending the webinar. We hope to make this a quarterly event, maybe even more frequently, depending upon exactly what's going on in the capital markets. Certainly, we're looking to make this correlate with our quarterly outlook that I know many of you read and really respond to. So again, just want to thank you on behalf of the firm, CCR Wealth Management, on behalf of John and myself. Thank you for attending.
Thank you very much.